Hello, everyone, and welcome to today's webinar on navigating legal structures for blockchain finance and tokenization. My name is James Delaney, and I'm a managing director at AIMA in our asset management regulation team. Asset managers are increasingly interested in tokenization. According to AIMA and PwC's annual digital asset survey, last year it was revealed that 25% of traditional hedge funds, including those not currently invested in digital assets, say they are exploring tokenization. We're currently surveying members again for this year's report, and it will be interesting to observe how this interest may have materialized over the last 12 months. Findings are due out over the summer. An EY survey on tokenization published late last year revealed a particular interest in tokenized alternative assets. In terms of asset allocation, institutional investors are projected to allocate 5.6% of their portfolio to tokenized assets by 2026. High net worth investors anticipate an even higher allocation of 8.6%. Tokenization at a high level enables peer-to-peer transactions through smart contracts or digital contracts stored on a blockchain. Asset rights can be tokenized by converting them into digital assets that can be bought, sold, and traded on the blockchain. There are a number of benefits for issuers and investors, as well as challenges, which we will go into. Those who believe in tokenization feel it has the potential to revolutionize traditional financial markets by making assets more accessible, efficient, and transparent. Larry Fink, CEO of BlackRock, is a champion of this vision. During our discussion today, we will be looking at blockchain structured finance and tokenized fund developments, and the different legal structures currently being harnessed to tokenize real-world assets and funds. During the session, we'll cover legal structures available for compliant blockchain investment transactions, types of tokenized offerings, and recent and future developments in the blockchain finance legal landscape. I'm delighted to be joined by 4 experts in their fields, and I'll ask each of them to introduce themselves to you, their firm, and a bit about their journey into the digital asset space. Eli, perhaps beginning with yourself.
Sure. Thank you very much, James. Thanks everyone for listening to the webinar, and thanks to AIMA as well. My name is Eli Cohen. I'm the general counsel at Centrifuge. Centrifuge is an open source DeFi, decentralized finance protocol that is for tokenization and securitization of assets. It's a P2P open source, jurisdiction agnostic, legal structure agnostic platform where issuers of different types of securities tokens can come and create pools for borrowers or for investors to access their offerings. So it's principally being used for asset-backed securities and for fund management at the moment. And we have a number of different kinds of structures and pools. I've been in the space full-time, I would say, since 2019. I've been with Centrifuge for 2 years, and before that I was with a company called Block One in Hong Kong, and built a CFI, a centralized finance exchange called Bullish there, spot exchange for mostly BTC and ETH institutional clients. And previously to that, I was about 20 years, various different in-house roles at different financial market infrastructures in Europe and in Asia.
Brilliant. Thanks, Eli. Katherine?
Hi, all. Thanks for joining us and thanks for having me. I'm Chief Legal Officer of Cboe Digital, which is a U.S. regulated exchange and clearinghouse for crypto spot and crypto derivatives markets. Prior to joining Cboe Digital, I was General Counsel of Maple Finance, a decentralized finance protocol. And prior to that, I was a partner at the global law firm King & Spalding in investigations, white collar, defense, and regulatory matters. And my crypto journey is a lot like many people's in that I learned about the technology and I got more and more excited and interested and wanted to jump headfirst, which is how I ended up leaving a law firm for DeFi. The other thing that was really compelling is I co-chaired my firm's financial services industry group, and most of my long-term practice was representation of traditional financial services entities or TradFi entities in U.S. government investigations. And having seen how the sausage is made, I saw a lot of inefficiencies that could be solved by things like tokenization. So happy to be here.
Brilliant. Thanks, Catherine. Trish?
Hi, all. Thanks to everyone for joining. Thanks to AIMA for including me in this very impressive panel. I am a finance partner at the law firm of Reed Smith in New York. Reed Smith is a global full-service law firm And in particular, we have an internal group called Reed Smith on Chain that is dedicated to blockchain and crypto and other Web3 technologies. And, we have a global group of practitioners that are deep in this space. And we're always working together to collaborate and see what's going on in everyone's jurisdiction. I am in the structured finance group. Historically, I'm a structured finance, traditional finance lawyer. And I was approached by one of my partners about 5 years ago to help with a UCC issue, a very sort of rooted in traditional finance issue, where the collateral was Bitcoin and Ethereum. And that is where my journey began. And then it was the type of thing that once someone finds out a little bit about something, you are the go-to expert. And so I've learned a lot over 5 years and now do quite a bit in the crypto and blockchain space.
Brilliant, thank you. And last but no means least, Casandra.
Yes, thanks for having me, and thanks for everyone who's joining today. My name is Casandra Carpenter. I currently work at a full-service law firm called Polsinelli. I am based out of Kansas City, but prior to that, I worked at Orc in New York, and then after that, Deckard in San Francisco. My background has been structured finance and traditional structured finance in the sense of credit card receivables, student loans, equipment loans, commercial real estate structures. So that's my background, and I had this very similar one to Trish. Is someone came to me in a very they were going to take crypto as collateral for a loan, and they were like, "You know anything about this?" And I said, "No." This was 2019, but I also went in and started investigating on how to perfect in it and drafted, some sample, security agreements for it. And then all of a sudden I became the firm expert, and then sort of then moved from there and had a wonderful opportunity to help some other clients after that were kind of like, unfortunately, beginning of 2019. And we did a few deals where they were sort of doing like direct issuances, very simple, 506B or D offerings to investors that were being tokenized. And then from there, I've just moved all the way into where we're loading a securitization model and then tacking on tokenization on the back of it.
Brilliant. Thanks so much, Casandra. As I'm sure you will have all heard, we've got a huge wealth of knowledge here. So delighted that we're going to be able to tap into it and hear some fascinating insights and experiences. I also wanted to mention before we get going that there is an opportunity to ask questions. Anyone listening, there is a Q&A button on your screens. So please do feel free to use that, and we'll look to save some time towards the end to take those. Wanted to begin the conversation by looking at the current state of the market. Eli, you talked a little bit about Centrifuge in your opening remarks. Wanted to understand a bit more about where exactly you fit into the diverse digital asset ecosystem. And then also, as you mentioned, your sort of DeFi infrastructure protocols, securitizing, tokenizing, structured debt markets on chain. Can you talk a bit about how that actually works for our listeners, both, I suppose, from the perspective of a business or asset owner or originator, as well as perspective of an investor or lender? And then, I suppose, just finally tag on to that, sort of what are the benefits as you see them of putting debt products on chain?
For sure, James. I'd be happy to. So the space is very diverse. It's becoming more and more diverse all the time. I go to a lot of crypto conferences. We'll be in Texas next week for Consensus. I was in Dubai for Token 2049. It is an incredibly diverse ecosystem in the crypto markets, and people are doing almost everything you can think of, and probably a few things you can't. But our space, our little niche of the space, is called real world assets. So RWA, which is when we started, when Centrifuge started in 2021, really with our first pools, it was a pretty obscure space for sure. But it's become really, really much more well known and much more well used as the time has progressed, as the structures have become streamlined, as we put the rails in place to be able to launch more quickly. It's a space where you can take assets that are off-chain assets, so assets that don't exist in the on-chain blockchain world, and put them on the blockchain. Now that could be anything from individual pieces of art or property interests. But what we do at Centrifuge is really securitization. So we create securities tokens, securities pools for different types of investments. And the principal ones being used right now on the platform are for asset-backed securities. That was what we started with in 2021. We had a number of different asset-backed securities pools. We had some private credit pools that started in 2022. And then this year, we've really been focusing on fund management. We've got 2 on-chain investment funds. These are investment funds offshore investment funds issued in sort of traditional hedge fund structures, which have then been tokenized. And that there's a number of different advantages to doing that, particularly with the calculation of the NAV. So you can take over some of the responsibilities or automate some of the responsibilities of the fund administrator. And that can help the investors see NAV on a much more real-time or daily basis, even for our funds that you would normally be calculating NAV only monthly. So there are a number of different advantages. There are advantages in the securitization asset-backed security space in terms of streamlining things for types of issuers that wouldn't really have the wherewithal to do a full public bond offering. So we focus mainly initially on sort of small and medium-sized enterprises that could raise, 5 million, 10 million, 15 million, which is too small for a general asset-backed security, but you can do it on chain because of the streamlining and the need for less intermediaries in the space. So that's what we see. I think that, going forward, I think the communications aspects of having an issuer issue its securities directly to the investors and have a direct holding system are going to become very apparent, especially in the debt markets. For a bond offering, it's almost impossible for a bond issuer to figure out who its holders are at any given moment. It's an expensive enterprise, and therefore, if something happens, they need to do a restructuring. There's some sort of merger or acquisition of the company that the bond offering has to change. You have to get a vote of the bondholders. Very difficult to do. In the crypto markets, in the blockchain market, if you issue something on chain, it's much more efficient and it'll become much more easier for the issuers. So I think the issuer side is pretty obvious. And then on the investor side, really what we see for the most part now are investors that have assets in the crypto market. So they hold a lot of stable coins. And so most of the investors on the platform are big DeFi protocols and DAOs that hold a number of different stable coins that want to use the real world assets to balance out their portfolios. So they're invested in a number of different, local, DeFi yield products, and they need to be, have a portion of their portfolio in a much more secure structure. So they use the real world assets for that.
And that's really helpful to get that overview and what you see as some of the sort of current trends as well happening in the space. Katherine, wanted to turn to you to sort of get your thoughts, how you see it from Cboe Digital's perspective in terms of the current state of the tokenization market.
Yeah, so I joke that kind of particularly in 2023, tokenization was kind of the flavor of the year for TradFi in particular. And it's obvious because you can see the potential, particularly how it is transformative with respect to market structure. And I would say tokenization interest continues to grow, especially around collateral use cases. What's really interesting is you're seeing money being made with tokenization within the crypto ecosystem. You're seeing a lot of activity in the TradFi ecosystem with respect to tokenization, but a lot of that is very much in the R&D, research and development, experimental pilot stage. So there's not a lot of monetization with respect to TradFi engagement. Now there is potential opportunity and excitement around potential opportunity for registered regulated entities to offer additional use cases for, highly regulated and liquid tokenized collateral using that as an example. I think we're going to talk about that later. What is also interesting is you have seen a number of tokenized deals. For example, UBS has brought at least 4 separate tokenized deals to market, each in a completely different asset category, you know, from structured notes to bonds. And none of those deals appear on the surface to be commercially compelling. But query whether a lot of the players in this market are trying to build up their operational expertise through different kinds of tokenization issuances, which is really smart because they're developing the expertise to be able to capitalize on ultimately more strategic players in the space and hopefully a clearer regulatory environment for tokenization. Again, I think that's something we're going to talk more about later, but I will also say one of the things that this group talked about even in prep and goes to a couple of the questions that we're seeing in the Q&A thus far is that each jurisdiction treats tokenization differently. So that's what is somewhat confusing. Some jurisdictions treat a tokenized asset exactly the same legally as the underlying asset itself. So it's a tokenized security, it's treated as a security. Others treat the asset completely different, or there's supplemental law pertaining to the tokenized asset because it is tokenized. So all of a sudden, it's not just a security, it's actually treated akin to a crypto asset. Sometimes it's crypto specific, sometimes it's financial product specific. So it's very difficult to just say, oh, go with this jurisdiction or do X, Y, Z, because part of the beauty of tokenization is it does things like, you know, atomic settlement, it removes global barriers, but you also have to assess the many jurisdictions you might be touching, particularly with respect to your client engagement.
Thanks for that, Catherine. It feels like global convergence is quite far off as well, but we will come on to talk a bit about regulatory and what we're seeing in terms of the regulatory environment. Trish, I wanted to turn to you. Obviously, you sit in the structured finance team at Reed Smith, as you mentioned, and you advise on a variety of structured products. Can you talk to some of the various tokenization structures and the drivers that you've been seeing? And what are some of the legal structures that are used commonly in this space?
Sure. So I think one thing which is kind of, I don't know, following on nicely from what Catherine was just talking about is that tokenization can mean many different things in this context. And we see kind of everything from what I think is a more elaborate structure in something like a project we've done with Eli and Centrifuge to a much more, I don't know if simple is the right word, but using current traditional finance sort of technology in the documentation, let's say, and adopting that for a tokenization project. So I think I'll talk about the transaction I worked on with Eli a couple of years ago, because that's kind of an interesting structure. And Eli, please jump in and add color or tell me if I misremembered something. But there was a private credit fund that we worked with that wanted to and does now purchase real world assets. And those assets, I mean, I think they've considered a lot of different asset classes. And I think what they mostly are working on now is kind of senior secured debt held through DTC or maybe Euroclear, but clearing systems. That note or, you know, whatever their DTC ticket, they basically take that and through a verification process, it is converted into an NFT and turned over. Thank you, Eli, for nodding in agreement. Turned over to Centrifuge, and that's how it's tokenized. So in that instance, I just wanted to sort of drill down a little bit into the granularity there, because we're calling it tokenization. It's not actually tokenizing the asset itself, and anyone can jump in if you disagree with me. It's tokenizing what's a representation of that asset. You know, a certificate that says this SPV owns this asset. And then Centrifuge generates some debt and equity tokens representing the interest in that. in those underlying assets. And then the ultimate financing in that transaction was coming from a DeFi protocol called MakerDAO. And Maker was effectively providing funding at a very competitive rate back in the good old low rate days, where, there was a lot of margin to be made on pretty safe assets there. And the funding came from Maker through what's called DAI. It's their generated stablecoin. And the DAI then is held as is turned into, there's multiple transitions there, but is ultimately turned into the fiat cash that's used to purchase the asset, let's say. So in that instance, those investors are really coming in with, some kind of traditional currency, and ultimately receiving their, if they're investing in that front end credit fund, they're investing likely USD and they're receiving back USD. So from the investor's perspective, they actually don't interact with the blockchain, let's say. So that's kind of one structure we've seen. And then
just to interrupt you, I want to agree and reiterate the point that you made where it's not the asset itself. And the other thing that I've observed is it gets somewhat complicated these days with the legal status of these assets, of these tokenized assets, where you're using the blockchain, but you also have to have a separate manual ledger tracking the legal ownership of these assets. So that is always a point of frustration for people who are like, I wish we didn't need this ledger. But until we have ownership rights legally enshrined in the asset, there's still going to have to be a lot of work that needs to get done in addition to the tokenization and the actual facilitation of the deals you're talking about.
Okay.
Well, go ahead, Eli. Sorry.
Yeah, I was just going to say, we'll talk about this a little bit later, but I think in the funds industry, we're seeing a number of different fund admins who are working on systems for blockchain-based share registries. So to take the share registry function from a transfer agent or registrar or fund admin and put that on the blockchain itself, which would then solve for a number of those problems. But it's step by step, of course, and depends on the legal structure.
Yeah, and one of the things I think that was, may come up again a little later that I was going to talk about is what's always interesting in these transactions is sort of navigating, and Casandra, I think you probably experienced the same thing, but navigating in the legal documentation around the role of the smart contract, and figuring out how to sort of capture that automated function, making sure that it's clear that it's happening, but it's also clear that it's happening automatically when it should. So there's another sort of group of structures that we see that are in a way much more simplified because they basically rely on existing sort of the basics of existing common trading documentation, like the GIMSLA, the Global Master Securities Lending Agreement. Sometimes we draft something called a master loan agreement. And I mean, those structures are used frequently for treasury management transactions where, as I think, Eli, you were talking about, a lot of funders and groups are sitting on stablecoin and they want to just be in the blockchain space and do something with their stablecoin that they have to hold for whatever reason or are holding because they want to. So we see a lot of structures that may, repo that or use it, do it under or exchange it under a stock lending agreement. And then they basically are outsourcing the job of converting that to fiat currency or, traditional USD or sterling, investing it in, these days, a very nice treasury rate. And, they can let it sit out there gaining yield. Whereas, if it's sitting as USDC, pegged to $1, It's not being put to use and being deployed. So it's a way for people to deploy stablecoin that they're holding as their treasury currency. And we see that we've done that in various different formats. I think maybe, I don't know if Eli, you'd agree, because I think you'd heard of there is a BVI structure that is being used through a trust, and the trust is the investor in the USDC, or sorry, in the US Treasuries or whatever the real world asset is, and then it feeds back through to the investors through the trust structure.
Yeah, we see with the DAOs, you have to create a legal conduit or legal wrapper for them to be able to invest in real world assets or any kind of off-chain assets, because they need to go through a KYC AML process. So there needs to be some sort of legal entity involved that they create to be able to do that they can still control via on-chain voting. So there is mechanisms for that, a couple of different ones that are being used, but it's a challenge. And I know, Casandra, you also did a maker deal, so I don't know if you chat about that as well.
Should someone explain what a DAO is? I don't want to cut Casandra off. I don't know, Katherine, because you were the GC of one.
Maple Finance had a DAO, and basically a DAO, it's quite interesting. It's a decentralized autonomous organization, and they're collectively owned, kind of a blockchain governed of sorts. I'll call it like a group working towards a shared mission. So a lot of crypto companies have a DAO for governance purposes. And what is interesting is oftentimes the DAO holds the treasury of tokens. So that's what we're talking about, is those tokens. You need, in the DAO governance model, you need a group of people who all agree, like, we want our tokens, our pile of tokens to sit there and earn yield. What do we want to do with it? Well, here's a very easy way to effectively arb the treasury market. That's what we're talking about.
Sorry, I didn't mean to cut Casandra off. Casandra, you...
Oh, no problem.
Maker deal,
no problem. I also did a transaction with Maker, but the one transaction we did was to actually go to a traditional securitization for asset-backed. So we call it asset-backed in traditional finance. It's the same thing as real-world assets in crypto. It's backed by a real-world piece of paper, real estate, art. In this instance, it was backed by what we refer to as fix and flip loans, which are loans that investors take out to buy, residential real estate, fix it up, and then sell it. So it's a short-term loan. And so essentially, we had to figure out how to get the short-term loan to the investors. And so essentially we did put a securitization model on it where the issuer owned all the loans, and then they pledged those loans to a trustee. Okay, so the trustee functions as a lender in that transaction. Okay, and then they had enforcement rights, okay, to foreclose against all of those loans and to foreclose essentially against also the issuer into the equity of the issuer to take control of all the assets at once, or to take control over just, let's just say 2 of the 50 loans are defaulted, just to take the actual ownership interest in those loans. And then, so that was the securitization part of the model that we stuck onto the transaction. And then normally when in a normal, securitization, you would then have a whole bunch of other players besides the trustee. We did also, the trustee functioned as our custodian because they had to actually hold the legal debt papers, which are essentially the notes and the mortgages that the underlying borrowers took. But we removed a whole slew of other parties. So I know we're going to kind of go back into efficiencies and stuff, and normally those transactions, you would have had, a tax administrator, a bond administrator, potentially a currency, conversion agent if you were cross-border, right? You're going to have a note register that registers to like all the owners of the note, the underlying notes, the borrowers. So you have all of these other like smaller administrative functions. Sometimes you even have a collateral manager. You would then have a servicer, maybe actually 3 servicers in some jurisdictions, a primary servicer who does a very small functioning, And in real estate, that servicer sort of kind of goes out and inspects the properties to make sure that the business plan's been executed, and that there's, you know, and in that particular instance, that there's actually a property that is being fixed. And then you go into a master servicer who kind of collects all the money, and then a special servicer who then deals with any of the assets that become defaulted or impaired. In this case, I'm talking about the loans themselves becoming impaired, not the securities or the bonds, because there's another person that's the bond administrator that talks about impaired bonds. We removed a whole slew of those people from the transaction. So we ended up with, again, my trustee that had to be there. I needed my trustee to basically hold, to function as the lender, so that the ultimate investors could get to the cash flow. I'm trying to move them to the cash flow that's coming off of the loans so that they can get paid. So that's how we went through, and that investor then was able to invest into a pool of fix and flip loans, which gave them more diversification instead of buying just a token that's backed by one loan, right? That way that they feel like if one loan goes bad, it shouldn't mean that their investment is wiped out, because there's a level of what we refer to as over collateralization in the structure that should give them some comfort that they're going to continue to get paid. Now, in this instance, Maker was my senior investor, and then the client themselves, the issuer, came in and took the subordinate piece, so the smaller piece of it. But that way, Maker was able to get into all of their fix and flip loans, so all 150 that we had, and then be diversified. And then obviously we removed, some of it. The trustee still had to get the money, figure out the money, and then push all the rest of the stuff through. But it was a huge level of efficiency, and it allowed Maker to come in and be able to be part of the pool of these assets for their longevity. And again, as I said, these are shorter termed assets. As we know, these are fix and flips. So loans are coming in and out and being verified. As they get paid off, another loan can come in. So they can keep a constant, cash flow stream with having the benefits of securitization, diversification, and not as many of the costs, if that makes sense. Mm-hmm. Not as many of the costs. There's a lot less financial intermediaries in that structure than in any traditional securitization structure, especially one that involves real estate. I mean, in the United States, real estate is a localized product, and to be able to realize on that asset if something goes poorly, from a mortgage lender, more or less from the trustee trying to realize on it, can get complicated in some fashion, just due to the fact that you're in a local jurisdiction. And the state of Louisiana has completely different foreclosure laws than New York. So it's trying to simplify that process, and not only simplify it in the sense that the pledge of the equity interest in the issuer, if a number of the underlying assets went poorly, they could remove themselves from that transaction and just literally foreclose on the issuer, become the owner of everything they own, performing and non-performing, and then had a function to go out after that and to either enforce or just sell off the loans. That can get a little bit more inefficient, but to sell off the loans one by one if they had to, or in a portfolio, or foreclose and then sell the real estate. There was just a lot of options there to actually realize if things, ended up not going as structured.
Yeah, it was really, Cassandra, it was a really amazing deal, because you have on the one side a DAO, a huge DAO Maker, with using its own stablecoin DAI to invest in real world assets, traditional financial assets, with a full level of investor protection, which is, I don't know that there's very many other deals like that out there. So it was an amazing model that you worked on.
Yeah, it was a lot of fun, and it was very easy to work with Maker and agree. When you're talking about their DAO, we were able to get all of our documents up, and had Q&A questions, and, essentially they took their vote. It was a much simpler process than what I see when we execute on our bond sales, right? That's a lot of underwriter calls. Okay. There's a lot of, what they refer to in my words, they call it the road show. So everybody gets on the road and talks to all the investors and flies from, London to New York they go to Des Moines to sell to the insurance companies. I mean, it was far more simple, and it was far more real time in the sense that we were getting questions out of the forum and from, their, internal legal, and we were able to answer at 11 o'clock at night and then have something posted within an hour versus getting on a plane in New York and then having questions and not knowing and landing in London and having 50 questions on 5 loans that, I didn't even know that I had questions on.
It's incredible. Yeah, the efficiencies you highlighted there. I think, I suppose I wanted to get your view also on what were some of the challenges in terms of lessons learned from that process, or what are some of the legal uncertainties that challenged you during that effort?
Yeah, I was going to say, well, the legal, for Maker, that one was fine because we knew who our investor was, but it goes all back to what Catherine says is where you're issuing, what do they think it is? Do they think it's crypto? Do they think it's fintech? I have on another transaction where we were selling in Europe, and we spent hours and hours and hours and hours trying to figure out what, the French government was going to define it as. And that was in the pre-structuring. We haven't produced a single piece of paper yet. And we spent hours on that. That's the number one legal challenge, I'm sorry, is to figure out what everybody else thinks, especially when you're moving around and you have multiple investors that in this case are not just Maker, because we knew what Maker thought. We knew what was going on. We had, that one was easy, but it's when you sell to multiple people and they're in different places and you're like, okay, well, how am I going to figure this out? What are your potential, and I know this is the word that no one likes in the United States, but the tax ramifications. We had the entire international tax team coming on board. Again, we're pre-planning. I'm telling you, there's not a single piece of paper actually being produced at this point in time. I think that's the biggest challenge that I see. But I also see some other, dovetailing into some strengths of these platforms. While you have those challenges, I also think you have the efficiencies in a lot of these cross-border transactions where there's a multiple steps of intermediaries. I might have a collateral manager that's doing NAV at this, then I have a currency exchange party, and then they're doing something, and then they got to go back to the collateral manager when things are converting, and you're removing those people from the transaction. And, I'm not saying that I've had a wonderful career with multiple of traditional banks that do these functions. But, they don't do them for free. So that's the other thing I want everyone to know. They don't do those for free. So those cost money. I do think that this process is more efficient in that instance. You have less intermediaries in there and you have lower fees. And if I'm an investor, those are important things to me that, I'm not having to pay 8 other, administrators doing various functions.
Yeah, I would echo what Cassandra's saying about the regulatory piece. And in particular, I think in the US, the sort of lack of regulatory clarity and the sort of fear of regulation through enforcement, that scares the type of participants that I think we all deal with. And, everyone wants to do deals, but in the most conservative way possible to make sure they are within, they're not falling afoul accidentally of any, regulator that might have an eye on them. And then
I was going to say, when you did that, again, in these offerings that I've done, we have them in the legal world. We call them risk factors. So, lawyers can write risk factors on everything. You walk outside, you may not make it home, right? But that was a big trick. I mean, right? So you're saying a lot of things like, we're not sure what this party will do. We're not sure if FINRA will come in. We're not sure about this regulator. You know, there's all these cases with the SEC. You should be aware of them. And spend hours crafting those. And in some instances, they're big unknowns. Like, I mean, it isn't like this has happened one time and the IRS has done something and we don't think it applies here, but you should know that maybe they would expand. Like, it's an unknown. It's not
most of it's unknown, but that's the thing that I hate to say it, that crypto GCs hate about outside counsel. It's, well, all of this could happen. It depends. So, you know, it is what it is. It's part of engaging with a nascent asset class and with new technology. So I definitely agree that there's regulatory minefields and risks in engaging with new technology that isn't directly addressed by statute or even precedent. But I will say that's what's interesting about observing the broader landscape. And, you know, this goes to a question that I just saw in the chat, you know, like what areas of TradFi are best to gain momentum and in what jurisdiction? I think you can look to some of the examples. The one that immediately springs to mind in my mind is HSBC's launch of the HSBC Gold Token, which provides tokenized gold to retail investors in Hong Kong. I saw that as a pretty significant move in asset tokenization, as you know, HSBC, as far as I understand, was the first bank to provide retail investors with a tokenized real world asset on a large scale. And I thought that's a pretty good miniature case study of how this can be done and possibly monetized through regulatory engagement, because this was the first retail product in Hong Kong based on distributed ledger technology authorized by Hong Kong Securities and Futures Commission. So they had that direct engagement with the regulator, which is what you can do as a global bank. It's much more difficult for crypto companies to engage with regulators to the degree that, you know, public companies or banks can. They don't necessarily have the direct line of access. They don't have the policy teams, but I can see that some of the larger players in the space, like the banks, like the TradFi entities, engaging with regulators about these issues will then create, you know, kind of a roadmap or, you know, cut through the chaff of on behalf of other smaller entities. That's at least my hope.
Yeah. And I would agree when you said that. I mean, again, with following the amount of funds that are interested in this space. Okay. I'm also hoping that some of these issuers can partner up with those type of entities that are coming in from the investor side, because they too, Catherine, have those relationships. They know them. And so if it can be like a collaboration to get some of them together with the right people in the right jurisdictions that are going to answer the questions and to give the certainty that is needed. And especially, I think, overseas, that it's right for that.
Well, and you look at a lot of these deals and there has to be many parties involved. It's not like one party, like two counterparties. It's, you have the entity that is tokenizing the asset, issuing the issuer, the one who's doing the actual tokenization, the listing venue, for example, in the trading context. So you have a bunch of parties working together. So I do think the thing that I feel very positive about that makes me bullish about tokenization, even if it's very early, is that you have a lot of really tier one parties investing in learning and engaging with this. So it might take a while, but that makes it more attractive for everyone else, both on the basic kind of FOMO level, but also the fact that, okay, I want to do this. I need credible strategic partners with lawyers. Now there's more to choose from. There's a lot more to choose from now than there was even 2 years ago.
That's right. That's right. That makes a big difference. You really need the whole ecosystem. I think what we found is the risks, the issues are not so much with the regulatory structures or the regulatory certainty. I mean, because we mostly deal with, you know, exempt offerings under Reg D or regulated funds in offshore jurisdictions in Cayman or in BVI. But what we found the biggest issue is with the service providers, especially the choke point 2.0 issues that we've had with U.S. banks, U.S. Custodians, brokers, and even when you get those accounts set up, I know that our issuers have had a lot of constant compliance questionnaires to fill out about what they're doing in the crypto space and what does this mean, just explaining what they're doing and why it's okay, why it's not in violation of any rules, is very, very challenging. But
Exactly, Eli. It's so challenging. And someone just noted in the chat that to hold the HSBC Gold token, you have to be in Hong Kong. You need a Hong Kong residential address. You need an active HSBC HK investment account. Absolutely. In a perfect world, it would just be like everybody can have this gold token anywhere they live, anywhere they move. But unfortunately, why is that not the case? Because of the regulatory environment. That is because of the regulatory environment. That's also why you're seeing a lot of crypto entities wall off the U.S. They'll block VPNs. They'll block IP addresses. There are a lot of participants in this ecosystem that assess the risk. They want to experiment. They see the efficiencies. They see the transformative potential with respect to market structure and fees and all the things that we've discussed. But there is extreme risk every time you basically onboard or open things up to another jurisdiction. And it's not even just risk of engaging with those individual retail consumers. Retail is obviously the highest risk. It's things like marketing. So there's no easy solution. I think that's why we are still very early in this process, and we might not see the type of scale that we all hope to see, in the next year or two. It's going to take some time before a lot of jurisdictions create not necessarily even just a clear infrastructure, but an infrastructure that accounts for the global movement of these assets and the potential for the global 24/7 operation movement of this kind of technology.
Can we just pivot slightly, Eli? Just wanted to get your thoughts on in terms of what you're seeing right now from the fund management market, the sort of the current state of digital asset fund management environment. What's the interest like there, and how are things progressing over recent times?
It's been amazing. It's just a huge amount of activity. And to go to one of the questions that we've got in the chat, BlackRock has launched a tokenized fund, right? Franklin Templeton has a version of a tokenized fund. So you see very, very large traditional financial players already in this market. The BlackRock, treasury fund that they've tokenized has hundreds of millions already in investment, and they only launched it a few months ago. So, it's a booming space for sure. And there's lots of other fund management companies that are very interested in getting into the space. The fund admins are developing a number of different blockchain-based systems. We're working with a number of them ourselves to try to help them. We've launched just last year our 2 first fund pools. So we've got 2 British Virgin Island professional funds that have launched different types of asset classes in a tokenized form for investors to invest in. And the fund management structure is a really a much easier sell in a lot of ways than the debt offerings that we had initially. The debt offerings, as Casandra has mentioned, come with a lot of different investor protection steps that you need to take to make sure that you can enforce your interests through a trustee in case of an insolvency or a default. The fund management structure, because you're holding tokenized shares of the fund itself, you've got a regulated structure, there's already a regulated environment with along traditional financial lines that you can follow, and you can make your claims in case of there's some sort of a default. But the underlying assets are there, and there's an oversight arrangement, there's auditors, and there's a fund admin that checks everything. So I think people feel quite comfortable, buying a BlackRock tokenized share, and they feel fairly comfortable with the tokenized funds that we've got on our platform as well from an investor protection standpoint. And the funds give you a lot of flexibility in terms of asset classes. There's tons of different asset classes out there. Catherine mentioned gold. There's, people I know are working on commodities funds, tokenized commodities funds, but there's all kinds of other asset classes that you can use a fund structure for, which I think, are going to be very valuable in the RWA space in the crypto markets.
That's great. Thanks, Eli, for sharing those insights. Catherine, you mentioned, I think, earlier on in the conversation around tokenized collateral, and that's an area that a lot of people are watching when it comes to evolution of tokenized assets. Can you talk a bit about what you're seeing there? What's getting you excited in terms of that space?
Yeah, and that is a perfect segue to Eli's mention of all the different uses of tokenization, and we could go on and on. You know, I mean, like repo transactions, correspondent banking, trade financing, tokenized carbon credits, tokenization as a means of complying with Sharia law. Like it's really fascinating. Whereas a lot of people just think of tokenization as kind of the RWA, which is important, but of course, I would say it's really interesting when you look at the regulatory environment, how tokenization can open up some fluidity, like tokenized assets that could be used as collateral for swaps. There is a potential regulatory path forward for that use of collateral. And look, at the end of the day, tokenized collateral means increased access to liquidity, reduced barriers for borrowers and collateralized lending, you know, access to a broader range of lenders, faster settlement, potentially a broader investor base. I would say added capabilities for assets previously unavailable for use as collateral. And to the conversation that we've been having, overall reduced transactional friction. It's also interesting, we've talked about BlackRock's tokenized fund. A number of entities, I know FalconX, and I believe some of the centralized exchanges has started accepting it as trading collateral. So I would say the tokenization interest, we've talked about how it continues to grow. I would say it's especially growing around collateral use cases, which is a way where parties can engage with tokenization at an arm's length. You know, maybe their risk appetite isn't where they need it to be to actually get to the meat of tokenization, but they will consider tokenized collateral. They will communicate with regulators about it. So it's very promising.
Brilliant. Thanks for that. Casandra, I wanted to turn to you in terms of sort of what conversations you're having now with issuers, investors, clients, prospects, sort of who are looking at structured finance transactions through tokenization. Where are you in those discussions? Is it increasing in terms of the number of conversations you're having?
Yeah, it is definitely increasing, and I've had in the last 6 months 3 different platforms come up and want to talk about going into commercial real estate. So using commercial real estate or commercial real estate loans, and using the same asset-backed model that we've been using for the residential loans. And then even just recently in a very preliminary discussion, someone was talking about whether or not we thought we could do this with private student loans, which would be another whole run that I have not done unless anyone else says we couldn't find any current market on that. But that was also very interesting to, again, try to do the same reason why people use securitization is to get to a pool of assets that are diversified so that when you invest, you know, you're invested in something that's 1, liquid, more liquid than a loan, and 2, gives you the ability to not be just dependent upon one borrower honoring their obligations under their debt instrument. You've diversified yourself to 300 of them, and you know, hopefully 250 make it, then you know, everything's going great, you know, before you have any problems. That one I found was really interesting. And that was just a discussion I had 2 weeks ago.
Wow. Okay. I mean, as Catherine said, the use cases go on and on. Trish, just wanted to get your thoughts as well on that in terms of also, obviously things are happening and it feels like this is unstoppable in many ways now, but what is going to be the trigger for really seeing mass adoption here? What's sort of potentially holding it back? Is it the regulatory environment, as we've talked about?
I mean, I think it's the regulatory. Sorry, go ahead, James.
No, go, please.
No, I was going to say, I mean, obviously, I think the regulatory environment is always something people are conscious of and watching, and it's, you know, it overlays a lot of decisions as to whether to go forward with something. But, you know, I think going back to, I think Eli was the one who mentioned it. I think really getting both kind of third-party service providers engaged and also broader institutional engagement. I mean, frequently now when we're doing transactions, when we have to find a custodian, when we have to find an account bank, when we have to find a trustee, there's just a small pool of options of who we can choose from. And often those are not sort of the same players that you would see in traditional finance transactions. So, you know, if we want an account bank, that really ends up touching crypto. Choices are very limited. We also find that there are financial institutions that are kind of curious or crypto curious about the process and what it would look like. And they have people out there kind of meeting people at conferences and on panels and doing some marketing. But then, it's the case when our clients want to actually engage them and use them, there's, they really have some challenges with their own internal compliance at these institutions that they can't meet the needs of what these market participants need for these transactions. So I think really, that sort of having service providers open up and engage will, I think, sort of lift a lot of the barriers to people just, having some more liquidity of transactions going on.
Trish, I think that's absolutely right. And just to add to that, obviously we've touched on the regulatory environment, but I attended the OCC's all-day symposium on the tokenization of real-world assets and liabilities program back in February. And it was academics, regulators, economists, and many panelists discussed the lack of legal infrastructure, meaning separate and apart from the regulatory environment. In the absence of legal statutes and precedent to enshrine ownership rights in tokens, you're dependent on the contractual obligations of the issuer. And separately, the need for negotiation with tokenized assets. So I think that's a potential barrier too. The regulatory guidelines, an issue. Both of those things are going to change eventually. Like, we're seeing progress. And what is quite positive is you have a lot of people that are crypto skeptics, but they're far more open to learning and hearing about blockchain technology or tokenization as opposed to engagement with crypto assets. So I think that just the fact that there was an OCC symposium with all of these global regulators, who also, by the way, noted a significant increase in regulatory clarity globally, with the EU, Switzerland, and Singapore called out specifically due to new legislation addressing tokens and tokenization. So you're seeing a spectrum of regulators, but you're seeing progress.
So to your point on legal infrastructure, I'll tell you one thing that would make my life so much better is Article 12 of the UCC.
Yes.
It's really, we're always sort of trying to shove a square peg into a round hole for the most part, with security interests. So yeah.
And the last thing, the biggest probably impediment is for scaling tokenization is market structure change, meaning that infinite financial institutions like all of these, they have specific revenue objectives and goals, and they're particularly public companies. They're incentivized to stay the course and oppose a system that may create short-term value losses, even if that ultimately generates replacement revenue and brings other opportunities in the long term. So that's kind of obvious, but very important to acknowledge in this environment.
Yeah. Just also on the regulatory side, I know, James, you were in the Gulf as was I, and I think the Abu Dhabi regulator, the FRSA, and also the VARA in Dubai are really far along in terms of how they're approaching digital assets as well. So you see, if you look outside the U.S., you see very different views and very different mood among the regulators.
Thanks for adding that, Eli. I see we're almost up at time. We have about a minute left, and it's flown by. I know we had a couple of questions we weren't able to get to, but I'm sure all the panelists would be very happy for anyone to reach out to them if they have any follow-up questions around structuring of the products. We had a couple of questions around that, for example. So it really just leaves me otherwise to thank so much our panelists today for sharing with you their insights, their thoughts, and their experiences. Thank you, everyone who dialed in for listening and contributing with your questions. Otherwise, that just leaves me to say goodbye for now and see you again soon.
Thanks, everyone.
Thank you, everyone. Have a good day.